Welcome. Today we're digging into something really practical for UK homeowners. This discussion about understanding allowable home improvements for capital gains tax comes courtesy of ProTax Accountant. They're a well-known firm here in the UK and arranged this for us.
That's right. We're essentially looking at how you can potentially reduce your tax bill when you sell a property that's, well, gone up in value.
Okay, so capital gains tax, CGT, that's the tax on the profit you make, isn't it, when you sell an asset for more than you paid?
Precisely. The profit is the gain. But, and this is the crucial bit, you're not always taxed on the entire profit. Certain costs can be deducted.
And improvements are a big one for property owners.
Absolutely. Money you spend genuinely improving your property can often be offset against the gain, which lowers the amount you actually pay tax on. Understanding what counts is key.
Definitely key. And worth remembering the current context, too. For this tax year, 2024-2025, the personal annual exempt amount for CGT is, well, it's down to £3,000.
Quite low.
Yeah, so every deduction helps. And the rates for residential property in 2025, they're 18% for basic rate taxpayers, but jump to 24% if you're a higher or additional rate taxpayer.
For other things, like shares, it's 10% or 20%. So those property rates are, significant. Reducing the gain matters.
So let's take an example. Say you bought a flat for maybe £250,000.
Okay.
And you spent, say, £30,000 putting in a proper loft extension. Adds a bedroom, maybe?
Right. It's a substantial job.
Then later you sell it for £400,000. That £30,000 you spent, that potentially comes off the profit before you calculate the tax.
That's the idea, yes. That cost could reduce your taxable gain significantly.
So the big question then is, what exactly does HMRC consider an allowable improvement? What's the main rule here?
Well, the fundamental principle is the cost is only allowable if the work genuinely adds value to the property, and importantly, it's still part of the property when you sell it.
Adds value and is still there. Okay.
Think of it like this. Did it make the property inherently better or more valuable than just, say, fixing something that was broken? Basic repairs, routine maintenance, cosmetic stuff that generally doesn't count for reducing your CGT.
Right, not just patching things up. So can you give us some solid examples of what HMRC usually accepts?
Sure. Things like adding an extension side, rear, whatever that cost is typically allowable.
Makes sense. You're adding square footage.
Exactly. And converting a loft or a basement into usable living space. Again, usually deductible, full cost.
What about kitchens? People spend a lot on kitchens.
Kitchens are interesting. A new kitchen can be deductible, but it usually needs to be a genuine upgrade.
Upgrade, meaning?
Meaning it enhances the property's value beyond just replacing what was there. So if you rip out a very basic kitchen and install a much higher spec one, maybe change the layout for better flow that looks like an improvement.
But if you just swap old units for new ones that are pretty much the same quality?
That's more likely to be seen as a repair or replacement, you see,
Yeah.
not an improvement for CGT purposes.
Okay, that distinction between upgrade and replacement is really important then. What else?
Building a conservatory generally counts. Installing solar panels, green improvements often get the nod.
Good to know.
Even building a new boundary wall, if it genuinely enhances the property's use or value, not just fixing an old fence.
So structure, not just maintenance.
Yes. And structural alterations inside, like knocking down walls to create an open plan space, that usually qualifies. Oh, and major garden landscaping too.
Major landscaping, not just mowing the lawn, I assume.
Definitely not. We're talking significant permanent redesigns that add value, not just routine tidying up.
So it always comes back to this core idea. Did it enhance the property's value beyond just keeping it in good nick?
That's HMRC's golden rule, essentially.
Yeah.
Did it enhance the asset beyond simple maintenance? Is it a lasting improvement?
And it has to be physically part of the property when sold, you said. So if I put up a fancy, expensive gazebo, but then take it with me when I move.
Then no, you couldn't typically deduct the cost of the gazebo because it wasn't part of the asset that was sold.
Got it. Okay, let's make this really concrete. Can you run through a quick case study, show the difference claiming makes?
Sure. Let's imagine Bernard. He bought his house for £300,000 back in, say, 2016.
Okay.
In 2021, he spends £45,000 on a really nice loft conversion. Adds a proper bedroom and bathroom.
Right. Significant investment.
Then in 2024, he sells the house for £450,000. Now, without claiming the improvement.
His gain is £450K minus £300, so £150,000.
Exactly. £150,000 is his initial capital gain. But Bernard kept his receipts. He claims the £45,000 loft conversion cost.
So that reduces the gain.
Yes. His taxable gain becomes £150,000 minus £35,000, which is £105,000.
Ah, that's a big difference.
It is. Depending on his income tax rate, that £45,000 reduction could save him, well, potentially over £10,000 in CGT, £45,000 by 24%.
Wow. Okay, that really highlights why knowing this stuff is important. Now, you mentioned the line between repairs and improvements can be fuzzy sometimes. Let's clarify that. Examples of repairs.
Repairs are about restoration, fixing things. So, mending a leaking roof section, repainting flaky walls, fixing a broken window pane, unblocking drains, replacing a couple of damaged tiles, that kind of thing.
Just bringing it back to its previous condition, basically.
Pretty much, it's maintenance,
Yeah.
not deductible against the capital gain.
And improvements are more substantial.
Yes, improvements create something new or upgrade significantly. So instead of patching the roof, you install a completely new, higher quality roof.
Yeah.
Instead of just repainting, you knock down an internal wall to create a large kitchen diner.
Or adding central heating if it didn't have it before.
Exactly. Or maybe putting in a whole new bathroom where there wasn't one, like in Bernard's loft conversion. That's clearly an improvement.
So maybe a good mental checklist for listeners is, did it create something new? Did it substantially upgrade what was there? And is it still part of the house now?
That's a great way to put it. If you can answer yes to those, you're likely looking at an allowable improvement cost.
Good. Now, looking ahead to 2025, are there any specific tax changes related to this that people need on their radar?
Yes. Two main things. First, as we touched on, the annual exempt amount of the tax-free allowance for CDT is only £3,000 now.
Which makes those deductions even more valuable. Every pound counts more.
Precisely. Every legitimate improvement cost you can claim directly reduces tax you might otherwise pay. The second point is crucial for property sales.
Go on.
It's the 60-day reporting window. This isn't brand new. It's been around since April 2020, but many people still get caught out.
Right. This is for residential property sales where a CGT is due, like a second home or buy-to-let.
Exactly. If the property sale results in CGT and it's not covered by private residence relief, your main home relief, you have just 60 days from the completion date to report the gain to HMRC and pay the estimated tax.
60 days. That's quick. What happens if you miss it?
Penalties and interest can start racking up, so you really need to be organized.
Which brings us neatly to proof. If you want to claim these improvement costs, you need evidence, right? What does HMRC want to see?
Oh, absolutely. You need solid proof. Keep everything. That means invoices from builders, receipts for materials.
Proper VAT invoices where applicable.
Yes. Also, any architect's plans or fees, documents related to planning permissions, and crucially, bank statements showing you actually paid these amounts.
Makes sense. Anything else?
Photos can be surprisingly helpful. Before and after shots of the work can visually demonstrate that an improvement, not just a repair, took place.
Good idea. What if you did some of the work yourself? A bit of DIY. Can you charge for your time?
No. HMRC generally won't let you deduct the value of your own labor. It's only the actual cost of the materials you bought for the DIY improvement that you can potentially claim.
Okay, so just the materials cost for DIY. Unless
the work was done by, say, your own building company, which is properly registered and invoiced you correctly. But for typical DIY, it's just materials.
Got it. So thinking about all this, what are the common slip-ups people make?
Well, probably the biggest one is claiming for costs that are actually repairs or maintenance, not true improvements. Thinking of that new coat of paint or fixing the guttering counts.
What it doesn't.
Right. Another huge one is simply losing the paperwork. Years might pass between doing the work and selling the property. If you don't have the invoices or receipts, you can't prove the cost.
So no proof, no deduction.
Effectively, yes. And thirdly, as we just discussed, forgetting that 60-day deadline for reporting and paying CGT on relevant property sales, that can be a costly mistake.
Okay, so quick fixes. Be honest about whether it's a real improvement. Keep meticulous records, maybe a dedicated folder, physical or digital, from day one.
Definitely. Start that folder as soon as you do any major work.
And set calendar alerts for that 60-day deadline if you're selling a property where CGT might apply.
Couldn't agree more. Being organized is half the battle. So, wrapping this up, understanding what counts as an allowable improvement is just fundamental to managing your capital gains tax when selling property in the UK.
It really boils down to distinguishing those value-adding enhancements from the everyday upkeep costs, which you generally can't claim for CGT.
And with that lower £3,000 annual allowance for 2025, making sure you identify and evidence every single allowable improvement cost is more critical than ever for reducing your potential tax bill.
Absolutely. So the key takeaways are, Know the difference between improvements and repairs, keep meticulous records of costs, and be really mindful of that 60-day reporting rule for residential property sales.
And of course, everyone's situation is slightly different. For specific advice tailored to your circumstances, making sure your calculations are correct and you're claiming everything you're entitled to, it's always best to get professional help. We'd certainly suggest reaching out to the team at ProTax Accountant.
Sound advice. Well, that brings us to the end of our discussion today. Thanks for tuning in.